Warren Buffett is widely regarded as one of the greatest investors in history, and for good reason. Over the course of more than 6 decades, Buffett has transformed Berkshire Hathaway from a struggling textile company into one of the most successful conglomerates on the planet. His long-term, value-oriented investing approach has yielded extraordinary returns, with Berkshire stock compounding at an average annual rate of around 20% since he took over as CEO in the mid-1960s. To put that into perspective, the S&P 500 has averaged around 10% per year over the same period. That difference may not seem massive on the surface, but when compounded over decades, it results in an astronomical gap. Berkshire Hathaway shareholders have seen their investments grow by more than 5 million%, compared to less than 35,000% for the broader index. That's the power of compounding combined with disciplined stock selection. And as we move into a new investing era, one where Buffett is expected to take a more hands-off role and Berkshire's future will increasingly be steered by successors like Greg Abel, many investors are wondering what kind of stocks the Oracle of Omaha would still consider worthy of holding for the long haul. Buffett has always had a knack for finding undervalued companies with durable competitive advantages, strong cash flows, and shareholder-friendly capital allocation. While his portfolio has typically leaned heavily toward U.S.-based businesses, Buffett has also shown a willingness to venture into less conventional territory when the value proposition is strong enough. With that in mind, here are 3 stocks that fit the mold of what Buffett has historically favored. Stocks that generate strong cash flows, boast attractive valuations, and offer long-term upside with a margin of safety. So if you're serious about investing and want to position yourself for massive gains before the rest of the market catches on, make sure to watch this video till the end and remember to subscribe and turn on notifications so you never miss an update on the hottest stocks in the market. Let's aim for 100 likes on this video so more people can reach and benefit from this info. The first stock that Warren Buffett could spend millions on is Altria Group, trading under the ticker symbol MO on the NYSE. Altria is a name that often gets dismissed in modern investment circles, not necessarily because of its performance or fundamentals, but because of its association with the tobacco industry. While many ESG-focused investors have put Altria on their do-not-touch list, that's exactly the kind of market sentiment that creates the kind of long-term value Buffett is known for capitalizing on. Throughout his career, Buffett has emphasized buying great businesses at fair prices, especially those with strong cash flows, economic moats, and the ability to generate consistent returns regardless of public perception. Altria checks many of those boxes. Despite being in a controversial industry, Altria remains a powerhouse in consumer staples. It owns iconic brands like Marlboro in the U.S., which commands a significant market share and enjoys impressive pricing power. This dominance in a relatively inelastic product category gives Altria a reliable revenue stream. Even as smoking rates in the U.S. continue to decline, the company has been able to offset volume drops by steadily increasing prices, a textbook example of pricing power at work. This is the kind of advantage that Buffett has always admired, a business that can raise prices without losing customers, leading to higher margins and stronger profitability. Speaking of margins, Altria's operating margin is among the highest in its sector, a testament to its efficient business model. But where the company really shines is in its ability to convert those profits into cash. Altria generates billions in free cash flow annually, and this cash is returned to shareholders in a way that is both aggressive and sustainable. The company's current dividend yield is an eye-popping 6.9%, and it has a long track record of raising this dividend year after year. Buffett has often said he likes businesses that reward shareholders, and Altria's capital return program, through dividends and stock buybacks, embodies that principle. Even in difficult macro environments, the company has consistently maintained and even increased its payout, showing both discipline and confidence in its long-term earnings power. But beyond dividends, Altria has also made strategic investments that reflect a longer-term vision. The company owns a stake in Anheuser-Busch InBev, the global beverage giant, which has provided diversification outside of tobacco. It also invested in the cannabis company Cronos Group and in Juul Labs, a leader in vaping products. While those investments have had mixed results, They reflect a broader attempt to reposition the company for a future where traditional smoking is on the decline. Critics have pointed to regulatory risks and shifts in consumer behavior, but Altria's management has shown it's not sitting idle, it's adapting. That willingness to evolve, combined with the company's stable core business, creates a compelling long-term story. What makes Altria especially interesting from a valuation standpoint is just how cheap it is compared to its peers. Trading at just 9.5 times forward earnings, the stock is priced as if its business is in terminal decline. Yet year after year, Altria continues to prove the naysayers wrong. With consistent earnings, a fortress-like balance sheet, and reliable cash generation, the company is much more resilient than its low multiple suggests. For value investors like Buffett, who prioritize margin of safety and downside protection, that kind of mispricing can be a goldmine. In fact, Buffett has historically profited the most from situations where high-quality businesses are trading at distressed prices due to temporary issues or misunderstood risks. That's the lens through which one should view Altria, a misunderstood giant offering strong cash flow, defensive characteristics, and one of the highest shareholder yields in the market. Currently trading at $59.81. Altria represents a compelling opportunity for investors looking for income, stability, and a bit of contrarian courage. In a market often driven by sentiment and momentum, Altria stands out as a classic Buffett-style stock, fundamentally strong, attractively priced, and built to endure. It may not make the headlines for innovation or growth, but it quietly compounds wealth quarter after quarter in a way that would make any long-term investor proud. If Buffett were looking to deploy capital in this sector today, Altria would almost certainly be on his radar, if not already in his portfolio. The second stock that Warren Buffett could spend millions on is Alibaba Group Holding, trading under the ticker symbol Alibaba on the NYSE. Alibaba has been one of the most talked about and arguably one of the most misunderstood tech companies of the past decade. Once the darling of global investors, the Chinese e-commerce and cloud computing behemoth has faced a massive wave of regulatory headwinds, geopolitical tensions, and macroeconomic uncertainty. The result? Its stock price has plummeted from all-time highs, creating what many value investors believe is one of the most asymmetric opportunities in the market today. While Warren Buffett himself has never directly invested in Alibaba, his late partner, Charlie Munger, famously did through the Daily Journal. Alibaba operates in a space that mirrors Amazon in many ways, but on a scale that's arguably even more impressive when viewed through the lens of China's consumer market. The company runs the largest e-commerce platforms in China, including Taobao and Tmall, which dominate market share and facilitate trillions of yuan in gross merchandise volume annually. On top of its retail dominance, Alibaba is also a major player in cloud computing via Alibaba Cloud, one of the fastest-growing segments of its business. Then there's its fintech arm, which includes Ant Group, a powerhouse in digital payments and financial services. This sprawling ecosystem, which touches everything from logistics to AI, makes Alibaba one of the most integral companies in the Chinese economy and one of the most robust cash-generating machines in the world. Despite its dominance, Alibaba has been punished by both Western and Chinese investors for a variety of reasons. Beijing's regulatory crackdown on tech giants, including a canceled IPO of Ant Group and hefty fines, rattled market confidence. Concerns about data security, censorship, and the opaque nature of China's political environment have led many to flee Chinese equities altogether. But therein lies the opportunity. While the risks are real, they appear to be more than priced in. Alibaba's valuation has collapsed to levels typically reserved for no-growth or distressed companies. Yet Alibaba continues to generate billions in free cash flow, sports a healthy balance sheet with significant cash reserves, and still dominates in sectors that are integral to modern life in China. Currently trading at $112, Alibaba is valued at a price-to-earnings ratio that belies its core fundamentals. Investors seem to be betting that either the business will collapse or that government interference will permanently impair its profitability. But recent developments suggest that Beijing may be backing off its harshest policies, recognizing the damage done to domestic innovation and investor confidence. Moreover, the Chinese economy is showing signs of stabilization, and with consumer demand returning, Alibaba is poised to benefit from any cyclical recovery. If those headwinds begin to ease, even modestly, the stock could see substantial upside. For a Buffett-style investor looking to buy a wonderful business at a fair or even cheap price, Alibaba is hard to ignore. It commands immense network effects, has multiple revenue streams, and enjoys a competitive moat in several high-barrier-to-entry industries. Its cloud division, in particular, could become a key profit center as China continues its digital transformation. While Buffett traditionally favors U.S.-based companies, he's never been entirely against international exposure, especially when the value proposition is too good to pass up. Under the new leadership of Greg Abel, it wouldn't be surprising to see Berkshire broaden its horizons further, especially in the hunt for undervalued tech assets with long-term potential. The broader lesson here is that sometimes the most obvious opportunities are hidden in plain sight. Alibaba's challenges are well known, but its strengths are often overlooked. It remains one of the few large-cap tech companies globally that is trading at a fraction of its intrinsic value, with a rock-solid business model and ample runway for growth. For Buffett, who has built his legacy on buying into panic and holding through recovery, Alibaba represents an idea that, if not now, then soon, could easily fit into the Berkshire mold. With patient capital and a tolerance for volatility, investors who follow that path may well be rewarded in time. The third stock that Warren Buffett could spend millions on is Northrop Grumman Corporation, trading under the ticker symbol NOC on the NYSE. Northrop Grumman is a defense contractor and aerospace technology company that has quietly built one of the most enviable positions in the entire defense sector. For decades, the company has been at the forefront of advanced military technology, providing essential systems, platforms, and solutions to the U.S. Department of Defense and allied nations. In a world increasingly defined by geopolitical tension and national security threats, a company like Northrop Grumman offers more than just strong returns. It offers strategic relevance, long-term demand, and high visibility into future cash flows. What sets Northrop Grumman apart is its diversified portfolio across key military domains. From unmanned systems and cybersecurity to missile defense and space-based technologies, the company is deeply embedded in virtually every aspect of modern warfare and defense infrastructure. Notably, its involvement in the B-21 Raider program, a next-generation stealth bomber, has placed Northrop at the center of one of the most ambitious and critical defense initiatives in recent history. The program is expected to generate long-term revenue over several decades, as it replaces aging aircraft in the U.S. Air Force's fleet. This kind of government-backed project is the kind of predictable revenue stream Buffett would love. Financially, Northrop Grumman is a fortress. It consistently posts strong earnings, with high margins and solid return on equity. Its free cash flow is robust, and its balance sheet is well managed. The company has returned billions to shareholders through dividends and buybacks, a practice that aligns closely with Buffett's appreciation for capital discipline and shareholder value. More importantly, its long-term contracts provide visibility and insulation from short-term economic cycles. Defense spending tends to remain stable or even rise during economic downturns, offering investors a defensive hedge in volatile markets. Currently trading at $5.16 per share, Northrop may seem expensive on a nominal basis, but on a fundamental basis, it remains reasonably priced given its quality, growth prospects, and strategic importance. In a global environment filled with uncertainty, from rising tensions in Eastern Europe to developments in the South China Sea, nations are rearming and modernizing at a rapid pace. That trend isn't going to reverse anytime soon, and companies like Northrop Grumman stand to benefit immensely over the next 2 to 3 decades. Buffett has always favored businesses that are essential, stable, and capable of weathering economic storms. Northrop Grumman fits that profile better than most. The company's contracts are tied to national security and its technologies are not easily replaceable. It also benefits from deep institutional knowledge, technological leadership, and relationships with defense agencies that span decades. These are exactly the kinds of moats Buffett has spent a lifetime seeking. To wrap things up, while Warren Buffett may not be the one directly pulling the trigger on new investments in the coming years, the principles he spent a lifetime preaching still hold strong. Look for companies with durable competitive advantages, strong free cash flows, solid balance sheets, shareholder-friendly management, and attractive valuations. Altria offers a high-yielding, undervalued play in the consumer staples sector. Alibaba represents deep value in a misunderstood but still highly profitable international tech giant, and Northrop Grumman gives investors long-term growth and defense exposure in a chaotic world. If you found this breakdown helpful, make sure to hit that subscribe button, like this video, and hit the notification bell so you never miss an update on the hottest stocks in the market. Folks, the stock market is gearing up for a massive shakeup in 2025, and if you're paying attention, you know this is exactly the kind of environment that breeds the next wave of breakout winners. We're not talking about your typical mega-cap tech giants. Today, we're diving deep into 3 tech penny stocks that are priced low but are brimming with potential for massive gains ahead. These are the kinds of companies flying under Wall Street's radar, but not for long. Whether it's bleeding-edge 3D printing, next-gen battery innovation, or disruptive insurance tech, each one of these firms is poised to capitalize on emerging trends that could turn small investments into life-changing profits. So, if you're serious about investing and want to position yourself early before the crowd catches on, make sure to watch this video till the end, and don't forget to subscribe and turn on the notification bell so you never miss an update on the hottest stocks in the market. Let's aim for 100 likes on this video so more people can reach and benefit from this info. The first stock on our list is Nano Dimension Limited, trading under the ticker symbol NNDM on the Nasdaq. Currently trading at just $1.39, a classic penny stock in terms of price. But what makes it stand out is the sophistication of the technology behind it. Nano Dimension is a trailblazer in the world of additive electronics, and its mission revolves around reshaping how electronic components are manufactured. The company has a global footprint and is widely recognized for its cutting-edge 3D printing systems. But these aren't your ordinary 3D printers. They're highly specialized machines designed to fabricate electronics, such as printed circuit boards, PCBs, antennas, and high-performance electronic components, layer by layer. This additive manufacturing approach has the potential to revolutionize the electronics industry by reducing waste, speeding up prototyping, and enabling designs that were previously impossible using traditional subtractive methods. Nano Dimension operates mainly through its printers and related product segment, which brought in $57.78 million in revenue over the past year. These revenues are largely driven by demand from industries that rely on electronic hardware innovation, such as aerospace, defense, automotive, and high-tech manufacturing. In Q1 2025, the company reported revenue of $14.4 million, representing an 8% year-over-year increase. This growth, though modest, is a positive sign in an industry that's still adjusting to post-pandemic supply chain realities and ongoing macroeconomic headwinds. But revenue alone doesn't tell the whole story. Nano Dimension, like many growth-stage tech firms, is still in the red when it comes to profitability. In the same quarter, the company posted a net loss of $23.78 million. However, there are strong indicators that Nano Dimension is working strategically to turn that around. For one, the company has made remarkable progress in improving its financial structure. Over the past 5 years, it has significantly reduced its debt-to-equity ratio, a critical metric that tells us the company is becoming more self-reliant and financially stable. Additionally, Nano Dimension ended Q1 2025 with a staggering $840 million in cash, cash equivalents, and investable securities. That kind of liquidity not only gives the company a cushion during turbulent times, but also provides the resources to continue innovating, acquiring, and expanding its market reach without the need for excessive borrowing or shareholder dilution. Perhaps most encouraging is the company's decisive approach to cost management. Operating expenses have dropped sharply from $25.3 million in Q1 2024 to just $14 million in the latest quarter. That's a massive operational improvement, driven by a new CEO who has implemented aggressive cost-cutting measures and discontinued underperforming products. These decisions are expected to generate approximately $20 million in annual operating expense savings, positioning Nano Dimension for more efficient growth going forward. The gross margin, which dropped slightly to 43.8% from 49.8%, reflects the transitional nature of these strategic moves. But as the company refines its cost structure and scales its production, margins are likely to improve. EBITDA losses also narrowed from $13.6 million to $9 million, signaling a step in the right direction. In terms of market sentiment, analysts have mixed views. While some point to the company's ongoing losses and call for caution with hold or sell ratings, others are far more bullish. The average 12-month price target stands at $10.20, with some forecasts reaching as high as $10.50. That represents a potential upside of over 630% from the current trading level. For investors willing to take on some risk in exchange for massive upside, Nano Dimension is one of the most compelling speculative plays in tech right now. The second stock on our list is CBAK Energy Technology Incorporated, trading under the ticker symbol CBAT on the Nasdaq. The current stock price stands at just $1.15, making it a deeply undervalued microcap that's nonetheless operating in one of the most critical sectors of the global economy: energy storage. CBAK is a battery manufacturer with operations spanning mainland China, Europe, and international markets. The company focuses on developing and distributing a range of lithium and sodium-ion batteries for applications in electric vehicles, light mobility solutions, and home energy storage systems. With a market capitalization of $98.93 million, CBAK may be small in size, but its strategic footprint and innovative focus put it in a unique position to benefit from the accelerating global transition to electric energy. The company's operations are divided into two core segments. The CBAT segment, which is their main battery business, generated $112.11 million in revenue. Meanwhile, the Hytron segment brought in an additional $40.62 million. While this diversified revenue stream is generally a strength, the company has faced some notable short-term challenges. In Q1 2025, CBAK reported net revenue of $34.9 million, a sharp 41% decline from the $58.82 million reported in the same period last year. That drop is primarily due to declines in certain parts of the battery business, especially segments exposed to fluctuating commodity prices and global supply chain disruptions. The revenue from the core battery business itself plummeted by 54.6%, clearly reflecting the pressure the company is under in its traditional product lines. Yet, despite these setbacks, there are several bright spots that investors should not overlook. For instance, revenue in the electric vehicle segment rose by 11.9%, suggesting growing traction in this critical area. Even more striking is the performance of the light electric vehicle segment. This includes batteries for scooters, bikes, and other compact mobility solutions, which grew by a whopping 88.4% year-over-year. As cities around the world shift toward greener, more efficient transport options, this could be a major growth engine for CBAK. On the other hand, the home energy storage business experienced a steep 60.4% decline, indicating that demand for residential battery systems may be cyclical or tied to specific subsidy programs. In terms of profitability, the company posted a net loss of $1.64 million in Q1 2025, compared to net income of $9.8 million during the same quarter last year. This is concerning, but not entirely unexpected for a company in the midst of a strategic transformation. One of the most exciting developments is KBAC's newly announced partnership with Kandi Technologies. Together, they plan to establish lithium battery production facilities in the United States, a move that positions the company to tap into the rapidly growing North American electric vehicle and off-road vehicle markets. With these sectors expected to be worth billions by 2030, this partnership could prove transformative. While Kapak's financials are currently under pressure, its strategic positioning and long-term vision make it an attractive option for forward-thinking investors. The low stock price of $1.15 leaves plenty of room for exponential returns if the company can execute on its U.S. expansion plans and regain top-line growth. As a speculative penny stock with exposure to one of the most important megatrends of our time, battery technology, CBAT may just be one catalyst away from a significant revaluation. The third and final stock on our list is SelectQuote Incorporated, trading under the ticker symbol SLQT on the New York Stock Exchange. Currently priced at $2.25 per share, this is another tech penny stock that is quietly making big moves in an industry that often flies under the radar: insurance and healthcare services. SelectQuote operates a technology-enabled platform that connects consumers directly with life insurance, senior healthcare plans like Medicare Advantage, and other health-related financial products. The company's model is simple yet powerful. Use data analytics, digital marketing, and licensed agents to help users find the best insurance coverage at the lowest possible price. But the real magic is in the scale. With a market capitalization of approximately $390.35 million, SelectQuote may be small relative to giants like UnitedHealth or Humana, but it's already generating massive revenues across three main segments. The life insurance segment generated $167.07 million. The senior segment brought in $632.07 million, and the healthcare services segment added another $673.90 million. Altogether, the company reported over $1.47 billion in segment revenues. And for fiscal year 2025, management is guiding toward full-year revenue in the range of $1.5 billion to $1.575 billion. This level of scale is practically unheard of for a company trading at such a low valuation. Even more encouraging is the recent financial performance. In Q1 2025, SelectQuote reported $48 million in revenue, an 8% increase over the same quarter in the previous year. More importantly, the company posted $38 million in adjusted EBITDA with a healthy 9% margin, indicating strong operating efficiency. What's even more impressive is the firm's cash flow profile. SelectQuote generated $71 million in operating cash flow and ended the quarter with $86 million in cash on the balance sheet. Even more telling is the commission's receivable balance, over $1 billion, which represents future revenue already locked in from previous policy sales. That kind of forward visibility is rare and valuable, especially in the penny stock world. Despite these positives, the company is still unprofitable and carries a relatively high net debt to equity ratio of 55.8%. But the management team has made meaningful progress over the past 5 years, reducing debt significantly and maintaining shareholder value without diluting the stock. According to recent earnings guidance, SelectQuote is expected to achieve profitability by the end of 2025, which will be a major milestone and likely a catalyst for institutional investors to get on board. Analysts are starting to take notice. Based on 4 Wall Street analyst reports over the last 3 months, the average 12-month price target for SLQT stands at $5.58, with the high estimate at $7 and a low at $2.75. This gives the stock a projected upside of over 150%, and even more if the company exceeds expectations. What makes SelectQuote truly unique is its business model's resilience and scalability. As the U.S. population continues to age and more consumers turn to online platforms for financial and insurance services, SelectQuote is well-positioned to benefit from secular tailwinds. Its digital-first approach and proprietary data systems give it a competitive edge that legacy players simply can't match. To wrap things up, these 3 promising tech penny stocks each brings something unique to the table. All 3 companies have the potential to deliver extraordinary returns for investors who are willing to get in early and stay patient. While they carry the usual risks associated with microcap stocks, The growth opportunities they offer could make them standout performers in 2025 and beyond. If you found this deep dive helpful, make sure to subscribe and turn on notifications so you never miss a beat. Thanks for watching, and see you in the next one. One of the most exciting developments is KBAC's newly announced partnership with Kandi Technologies. Together, they plan to establish lithium battery production facilities in the United States, a move that positions the company to tap into the rapidly growing North American electric vehicle and off-road vehicle markets. With these sectors expected to be worth billions by 2030, this partnership could prove transformative. While KBAC's financials are currently under pressure, its strategic positioning and long-term vision make it an attractive option for forward-thinking investors. The low stock price of $1.15 leaves plenty of room for exponential returns if the company can execute on its U.S. expansion plans and regain top-line growth. As a speculative penny stock with exposure to one of the most important megatrends of our time, battery technology, KBAT may just be one catalyst away from a significant revaluation.